Picture is about 10, 15 years old, so I wish you had updated it with a more recent picture. The gray should reflect. Anyhow, thank you so much, and it's good to see a full hall. And also good to see is the kind of topics that we are now discussing at a mutual fund event. I mean, the previous session was all very macro. And I think a lot of people in the room can remember how 10 years ago, such a session would have had an empty room. So I think it says a lot for the overall increase in the discourse level for this industry, and it's really good to see. Now, I actually do wear several hats, and I'm going to put on my policy hat for this conversation today. And I want to bring to you a flavor of the policy conversations globally to think about household finance. So household finance is a recent topic in academia. They have really focused a lot on markets and efficient market theory. But post-2008, there's been an increasing focus on this thing called household finance. And specifically for India, we have seen that policymakers, academics, regulators have looked at the household choice in India of real estate and gold with a little bit of a sneer to say that households are not very intelligent. They are choosing inefficient products for their money, whereas efficiency lies in markets. I'm sure we all remember the finance minister some years back who said, please stop buying gold. I'm making the propositions that actually household behavior is rational. It is the markets which have not induced the confidence in the Indian investor who is known otherwise as a consumer for being one of the most rational, value for money, sensible, feet on the ground person. How is it that the minute he comes to something like money, he becomes irrational? I'm saying probably the problem is on the supply side. In ULIPs, we know that investors lost more than 1.5 trillion rupees over a 7-year period. In traditional plans, due to lapsed policies, 30,000 crore a year is still going. We know that there are certain parts of the market which both in insurance and in mutual funds are still churning. Households are actually very confused by a fragmented marketplace with multiple regulators and the focus on AUM growth rather than investor servicing. A lot of focus has gone into things like financial literacy, educate the person, let's get people up to speed. This is called demand-side reform, and a recent committee, I'm sure you all heard of the Tarun Ramadurai committee. His mandate was to look at the problem of Indian preference for gold and real estate through a demand-side lens. And I do remember talking to him as he started work. I said, you know, Tarun, you are starting work on demand side, but let me assure you, your solutions will all be supply side. And that is exactly what happened. So solutions all were on the supply side. Demand will go when it feels safe. And we've seen that happening in mutual funds with the entire money flow into SIPs. I mean, that's one of the success stories of the Indian sort of regulatory policy industry and advisor, distributor, working together in a certain way. Let's take 2 or 3 steps back. What do I mean when I say seller beware? It means that we are not in a buyer beware market. What is a buyer beware market? Where the person who's buying a product has to be careful, has to make all the reasonable research and all that. Now, this buyer beware market rests out of the academic vision which has come out of the neoclassical economics theory, which looked at financially literate economic agents who would maximize utility. So we are not human beings, we are economic agents. We maximize utility after being fully informed. This market, and anyone who's on the street, on the ground, knows that this is absurd. Okay, especially when I sit in some of those academic meetings, you know, there's a sense of disbelief. What are these guys talking about? Real world is not like that. We know what real world is like. But at that 30,000 feet, it is financially literate, utility maximizing economic agents will choose the products they need once firms make full disclosure. It doesn't work like that. In buyer beware, the responsibility rests on the buyer. In seller beware, we turn it around and say that the person selling will make reasonable amount of, will be responsible for making a right sale. We're not saying that the money will always grow, but the condition of suitability will be met in a seller beware market. So I'm going to sort of unpack what the current market structure is like. It's saying that full disclosure will happen and financially literate consumers. Financial literacy we know doesn't work. What about disclosure? How do I move this? So do disclosures work? And I'm going to pull out of an example. I've hidden the company name. And this is not a mutual fund product, but I'm making a larger point on disclosure. This is a product which is assuring these returns. What comes to your mind? It's a 13% return, isn't it? Except that this is, of course, we know an insurance policy, and the 13% number is not on the investment, but it is on something called a sum assured. It's a third number. So full disclosure is being made. But is it relevant to the investor? What is the investor going to think? I'm getting 13% return. Let's look at Mediclaim policies. What does disclosure mean? What is the one thing in a Mediclaim policy that we should know? That when I go to the hospital, that company should pay. That is my moment of distress. It's the moment of truth. Let that company pay. And what, if we had a full disclosure model, what should that number be easily available to me as a consumer be? What is the disclosure experience? What is the claims experience of that product in that company? That data is almost impossible to find. The way that disclosure happens, it's all clubbed. It doesn't work. So there is a long way to go before even disclosure is correct. The current regime of disclosure across mutual funds and insurance also doesn't work, to a large extent because even the people selling don't know what they're supposed to know. I teamed up with an economist, Dr. Renuka Sane. She's now with the NIPFP. And we audited bank branches on sales. So we audited 400 bank branches. We hired an external agency. And we wanted to see what happens when a person goes in to buy a product. So there were two people. One was trying to buy just a simple tax-saving product, and an intelligent investor was trying to buy an ELSS. We all know that the intelligent investor will buy the ELSS. Otherwise, somebody will buy a life insurance policy. And it was across 25,000, 1 lakh. This paper is going to be printed in the Journal of Comparative Economics. And we found that this is the percentage of incorrect disclosure that bank branches, 400 bank branches in Delhi made across. And what are the things on which a financial product should be evaluated on? Surely it will be returns on guarantees, on costs, on lock-ins, and optimal holding period. For how long should a product be held? I mean, if you hold a short-term debt fund, to keep your money safe for a few months, it may not work. We found the percentage of incorrect disclosures across both mutual funds and insurance was very high. Insurance, it was higher, but even for mutual funds, it wasn't that disclosures were being made properly. So when I looked at, when the forms would come back, it was interesting to see the scribbles of the bank managers. A lot of times they said, koi cost nahi hai. It's free because there's no front load. So they were hiding costs of the expense ratio, whereas that was a key piece of the disclosure. Remember, we're trying to say that in the buyer beware model where disclosures have to be made, this disclosure should have been made. So on costs, they simply said, this is free. It doesn't cost you anything. In lock-in, most of the bank staff did not know that an ELSS had a 3-year lock-in. A lot of them said this product was guaranteed. I mean, that was the fear factor, that they were selling an ELSS guaranteeing return. The returns was, again, very interesting to see. Again, from the scribbles, we found that the bank officials were harvesting the highest return in the last few years and mentioning that. Ideally, they should have spoken about maybe a 5-year CAGR or a 7 or a 10-year CAGR for an equity ELSS fund. They were picking on that one return number from the last 1 or 2 years and sort of pushing the fund with that. So what in a seller beware market, how will it work? The regulatory cost of managing 1 billion transactions is going to be too hard. The one way it can work is product structure reform, something that we've seen in the mutual fund industry, where costs now sit in one place. It's also true of the NPS. It's not so true of the insurance product. We have to align incentives to get the person selling to do the right thing. So you get the product structure right. You align incentives. I mean, this is finance. It doesn't take a Nobel Prize to understand that everybody will maximize their utility, right? Whether it's the manufacturer or the seller or the consumer. You have to make the incentive structure in a manner that the person selling does the right thing. It is so much easier to regulate that market. It is so much easier for that market to not fail when these things happen. And we've seen some of these, we've seen this sort of play out in two parallel industries. So in terms of policy, it's very interesting to see a mutual fund case and a life insurance case in India. In the mutual fund case, we've seen 10 years of reform. I don't know how many people remember in 2009 when that front load went away. Everyone thought this industry is dead. I mean, everyone said this is finished. It will never revive. AMCs will go bust. Nothing will happen. What has happened? Exponential growth. So every time a reform was made, and in the previous session, Indranil was talking a lot about reform. But you know what? Reform is painful. And whichever sector it comes to, it becomes painful. If it comes to the media, it'll be painful for me. It already is coming, right? So it's painful wherever it comes. But once, for instance, this regulator in this industry bit the bullet, we've seen this over the next 10, 15 years, how it is playing out now. So SEBI pretty much took the monkey out of the product. It's still there, but it's much more easier to deal with now than it was some time back. Industry is maturing, SIP, we all know that story. I don't need to repeat that. What happened? Look at this graph. That blue line is gross and the red line is net. And look at the years of reform. It's not really linked to just the current market, which is last couple of years. It began a little before that. It'll be interesting to see how this goes further, if markets crash, what happens. But look at the way, this is only equity. Look at the way retail money is beginning to come in and sort of stay a little bit longer than it was staying before. Let's look at the insurance industry. Two products, there's a traditional plan, a ULIP plan. ULIP rules changed in 2010. A large part of the problem got sorted in the ULIP product. It is now not such a toxic product. There are small issues left, but really the big problem is over. But for some reason, the regulator left the traditional plan, which is where all the costs, the opaqueness, everything sits there. This is what happened to that industry. The blue line is the ULIP line, the red line is the traditional policy line. You see the inflection point. 2010, the ULIP regulations change, costs go down hugely. And which is the biggest cost, which was benefiting the insurance companies also, is your lapsation. Right? So if you don't pay the second or the third premium, the entire money is appropriated. Insurance companies were allowed to book profits after 2 years in ULIPs. Now they can't, but they can do in traditional plans, and they continue to do so. Irrespective of some reports that we have seen, the rules are that they can book profits of lapsed money in the first 2 to 3 years. So the cream is still sitting in the traditional plan. See how the industry has changed to manufacture and sell a product which we all know gives how much return over a 20-year period? How much? 4, 3.5, right? That's the return. People don't figure out because disclosures are poor, right? You are never disclose the IRR of the product. In a mutual fund, it'll be, you can't even imagine a world where you're not talking of a return in terms of a CAGR, IRR. But the insurance industry, for several reasons, is able to get away. So this is when I say that we need to get the policy right. We need to get regulation right. We are looking at the impact of regulatory change and policy change across two massive industries. Insurance is 29 trillion rupees of assets under management. Mutual funds are now 20 trillion. It's just 9 trillion short of the insurance number, but these are very, very large industries. And again, did this reform help the industry? No, because persistency is poor. After 5 years, they cannot retain more than not even half their business. For some private sector firms, they lose 88 to 85% of the business within the first 5 years. So it's that industry is a little bit of a basket case for investors, and they will figure it out at some point. So why does that become a problem? People stop trusting financial products. And here is where a policy shift to making the product, making the entire market move from a buyer beware market into a market where the seller has to ensure that the product is suitable. Right? So I was reading somewhere that an average person needs to take a few hundred decisions in a year for his finances. I mean, look at our own selves. How many products do we need? We need something for savings, for emergency fund, for car insurance, medical insurance, life insurance, short, medium, long-term savings, retirement. There are 9 or 10 needs or financial products that you need, not just in mutual funds, but across the whole basket of a person's, in the whole money box. Every product is sold by at least 10 to 15 companies. Every company will have, say, 25 to 30 products. Now, the disclosure model says that as a consumer investor, I need to read through all the documents. I need to read the offer document before investing, right? Who will read that offer document? How many will you read? It is impossible. It's really a buyer beware market in finance. Retail finance is like you're telling the people, okay, here is a car. You have to lift the bonnet and see if you think it is safe. Right? We cannot certify safety, but you will have to get a degree in engineering, in whatever else, to understand that this car is safe. For a person buying a financial product today, you need a degree in law, in finance, in economics, which comes to the role of the person selling, the distributor, the advisor, the planner. I mean, that's the crucial link. That's the person sitting facing the consumer. When you come into a seller beware market, it actually becomes safer even for the person selling, because then at some point, regulators will have to make metrics. Right now, anyone can come and blame, oh, you made a wrong sale. The minute there is standardization, then there is a metric. What is a right sale? What is a wrong sale? We don't know that. Regulators still don't know that. But what I'm saying, in the years ahead, these things will get sorted out. And even for the sellers, it actually means more safety. And I will just end with that. Thank you.
Monika, thank you so much for your presentation to us. And can I please request you to stay back on stage so that we can bring a small token of appreciation. I'd like to invite on stage Mr. Sanjay Sapre, President, Franklin Templeton, to help us thank Monika. Thank you, Sanjay. Thank you, Monika.